Good afternoon or good morning, wherever you may be in the world, and welcome to today's webinar, an update on EU financial services legislation and associated initiatives. Today we are privileged to hear from Dr. David Doyle, a leading expert on EU financial services regulation. David is a former diplomat with over 20 years' service on mainland Europe at the bilateral and multilateral level. He now acts as an EU policy advisor, specialising in regulatory developments in banking, fund management and insurance. We're proud to call David a long-term friend of the FS Club, and he last spoke with us earlier in the year in January, when supply chain disruptions, high inflation, record government debt levels and the energy crisis were starting to bear pressure on the international economy. Now, 6 months on, these pressures have intensified amid regulatory changes in Brussels, including revisions to long-standing regimes such as MiFID and new initiatives designed to reduce an over-reliance on non-EU countries. Before I hand over to David to dissect these regulatory changes and the effects they will have on us here in the UK, please bear with me for some brief housekeeping points. I'm Charlotte Dorber-Ashley and I manage the FS Club here at ZN. And I'm immensely grateful to our very generous sponsors who enable us to continue to bring you a wide range of thought-provoking content across finance, technology and economics. The slides for this presentation will be publicly available on our website and in the chat box, and the session will be recorded and available to watch on our website within 48 hours. We'll also be holding a 20-minute Q&A session after David's presentation, so please use the GoToWebinar chat facility to send your questions in to me so I can feed them into the conversation. Now, without further ado, it's my pleasure to hand over to you, David.
Thank you, Charlotte, and good afternoon, good morning, good evening to you all. Delighted to be back again with the Financial Services Club to present the latest developments on the EU regulatory agenda in terms of the financial services sector. Now, let's just perhaps go into our first slide, which talks upfront about the since the 1st of July, the Czech Republic has taken over the EU presidency in its 6-monthly rotational role. We've just had France as the EU presidency now, first week into the Czech Republic presidency, and it's proving to be, or it's certainly looking as if it's going to be a particularly challenging agenda for the Czech Republic, who will be piloting through the European Council and the European Parliament some really important pieces of legislation covering banks, asset managers and insurers. But probably the more ominous sign of how challenging this agenda is going to be comes from the revelation earlier this week that over 40 billion euros of EU corporate bonds are trading at distressed levels as we speak, which highlights, I think, for me, two big concerns. The first is the prospect of a declining economic outlook particularly across the Eurozone, triggering corporate anguish about the ability to pay their debts. And it also highlights the growing concerns by many economists and businesses across Europe about central banks' decisions to tighten monetary policy, which in turn triggers, of course, the prospect of this stoking recession in the major Eurozone countries, adding already fuel to the fire in terms of high levels of inflation, which at the moment in the Eurozone is running at about 8.1% up till the end of May, and is likely to increase beyond that. And this is obviously going to increase the cost of doing business for many corporates in Europe, both indigenous businesses and foreign companies. And now the other salient factor, of course, is the credit markets. Because of increasing inflation rates, the prospect of some hefty increases in interest rates going forward, perhaps not to the same degree of assertiveness as in the US, but nevertheless, the ECB is poised to increase its interest rates, which is likely to already increase the notion that credit markets are already pricing in a recession in terms of the credit policies, but it also has already provoked an early indication of declining credit quality. So going into 2023, I think we will continue to find supply constraints accentuated by food and energy prices, which are already very elevated, and the fear that central banks, not just in Europe, but across the globe, are probably going to prioritize combating inflation rather than economic growth. A very delicate balance that needs to be found if particularly the European Union is to continue to deal with its multiple challenges, not to mention the geopolitical issues right next on our doorstep, which are obviously provoking high energy costs as well. So it's in this context that, the Czech Republic will be taking, I think, a very lucid and a very managed approach to the current financial services regulatory items, which are pending discussion, review, approval, and of course implementation perhaps during the presidency, which ends the end of this year in December 2022. Let's just touch on some of the more important areas. Well, only last week we had news that the EU markets in crypto assets regulation had been approved. At least political agreement had been reached between the two major co-legislators, the Council and the European Parliament, with a potential 18 months before it actually starts applying, because unlike directives which can take a little bit longer, regulations tend to be immediately applicable after a transition period, allowing for regulatory technical standards to be devised by ESMA, approved by the European Commission, and obviously also endorsed by the Council and the Parliament. So this piece of game-changing legislation comes with some very notable authorization, licensing, prudential characteristics. I've always thought that this MICA, or MICA as they call it, is a sort of a mini bank prudential regime, which has a lot of the characteristics of that are currently being applied to banks, whether it be in relation to capital and liquidity, but also fit and proper assessments of managers, ongoing assessments of IT infrastructures, but it will have a very wide scope in terms of application, including providers, issuers, trading platforms, all subject to these new capital endowment rules, and also some pretty hefty AML rules and disclosures which also kick in. Interestingly, the capital requirements aspect is probably the single most important aspect, which took an incredible amount of time to work out at the European Parliament level. The question for issuers and for providers, and indeed for trading platforms, is a capital endowment. For issuers, it's at least 350,000 euros of capital. For providers, particularly significant providers with transactions in excess of 1 billion euros, there will be a 3% reserve required and an ongoing liquidity assessment requirement as well. There will also be some pretty tough rules with respect to directors, particularly senior management holders who will have to undergo fit and proper rules, which you already have in the draft bank regulatory framework under CRD 6 and CRR 3. But but this will be equally applied to all issuers, providers, and trading platforms. Interestingly, there are a number of exemptions, notably the non-fungible tokens have been excluded, although the Commissioner said it will return to this and review it in the next 18 months. There will also be a harmonized new supervisory regime, which will mean that the national competent authorities will have the key role in terms of authorizing and licensing all issuers and providers, with a certain significant amount of information, particularly in relation to providers, being shared with ESMA, who can, under certain circumstances, intervene and question the financial stability, characteristics and activities of some of these crypto asset players. And not surprisingly, given the circumstances, the disturbing circumstances that are occurring in the crypto asset sector at the moment, where the global crypto asset market has declined, has shrunk from something like $3 trillion US to $1 trillion as we speak, with many of the coin-based crypto assets declining by 70% in the last couple of weeks. So understandably, there has been, I think, a certain degree of political urgency in seeing this approved sooner than was anticipated. And I suspect that both the Council and the European Parliament will very promptly give its signing off to this piece of legislation so that it can be brought into force as soon as possible. Now, again, Europe is very far advanced compared to the other major regions of the world. In fact, it's setting the standards, in my view, for future legislation, whether it be in the US, Japan, China, or elsewhere. And clearly for third country crypto asset players, they will have to apply all of the EU rules. There will be no exceptions. There will be no equivalency type arrangements. They will have to simply apply all the rules going forward. The other important piece of legislation relates to the Basel III, or now Basel IV, finalization of the bank prudential rules. Now, this was first proposed in 2017. It was already a major amendment to the existing bank prudential rules in a decade. In 2021, October 2021, the Commission issued its proposals, interpretation of the Basel IV rules, which will not come as a surprise to learn that there are quite some significant divergences and additions compared to the Basel III, Basel IV regime, notably in relation to a brand new third country bank branch regime, which hitherto was left up to the national competent authorities in each of the 27 EU member states to license, authorize, and supervise, as they saw fit, the foreign bank branch entities, which incidentally do not fall under the SSM regime operated by the ECB. So it's very much left up to the national competent authorities. And it's interesting that there was a growing level of concern 2 years ago from the ESRB in its macro prudential report, which linked foreign bank branches to financial stability concerns. This was picked up very quickly by the EBA and by the European Commission, and it showed a number of interesting characteristics associated with the third country bank branches. There are something like, at this stage, 106 separate, sometimes fairly large foreign bank branches operating across the 27 EU member states, from the European Union, but mostly though from the US, Lebanon, China, Japan, and of course also now the United Kingdom, all operating as foreign bank branches in the 27 new member states. Represents something like 512 billion euros of assets under management, which are being transacted and held by these foreign bank branches, many of them holding significant and risky assets, in the words of the Commission. And perhaps more worryingly for the Commission was this notion, or discovery perhaps, somewhat belatedly, that many of the foreign bank branches were also operating on a cross-border basis, which was illegal. Normally, a bank branch of a foreign bank is granted a license in a specific EU member state, Estonia, the Republic of Ireland, France, Germany, Cyprus, or elsewhere, and it is only therefore authorized to provide a range of services for that particular state in which it obtained a license. But many of them were actually using it as a hub to provide activities across borders. Now, to this concern, of course, the EBA, in its note in June of last year, did not acknowledge that although they were only allowed to operate within the member state where they are established, and do not have a passporting rights, many of these foreign bank branches were operating significantly in the wholesale market, providing activities with financial interlinkages such as payments, settlements, clearing, custody, intra-financial systems borrowing, corporate banking, all of which, in the words of the EBA, may have significant interconnections with the EU internal market, end of quote. Added to this were the concerns that in the context of the imminent requirement under the intermediary holding company, the MEP-EU requirement, which kicks in December 2023 for all foreign bank groups, there was a certain, in the words of the EBA, a certain misalignment in the regulatory supervisory levels between third country banks, bank branches, and their EU subsidiaries, which lent itself to arbitrage opportunities, end of quote. For all these reasons, it was looking blatantly obvious that something needed to be done. And indeed, in its CRD6 CRR3 package, which is currently being reviewed by the European Parliament and Council, we are looking at a brand new regime which will kick in for any bank branch in excess of 30 billion euros. There is the prospect, but only the prospect at the stage, that the local national regulator, where that particular subsidiary has been granted a license, or that branch, should I say, that's been granted a license, will be called upon to subsidiarize, in other words, transform itself into a fully fledged, capitalized subsidiary going forward. Also, there will be other tools which will be introduced, such as the requirement to restructure the assets and liabilities of that particular branch so that it ceases to be systemic. Additional requirements will be introduced for branches and or subsidiaries of the third country group at group level. And there will be also some other more detailed disclosure requirements for third country bank branches vis-a-vis the national competent authorities where they have obtained license, something which is not being fully harmonized across Europe. Now, clearly, there's an awful lot more to be done here in terms of the actual details of these disclosures. First of all, the package itself has to be approved, and the earliest we're looking at is January 2025. But there's also other aspects which will lead, particularly in terms of the credit markets and counterparty risks going forward, where we're looking at capital charges by some estimates as high as 9% in terms of future capital requirements. Obviously, introduced on a step-by-step approach. It won't be a big bang approach, but clearly by 2030, we are looking at as high as 9% capital charges. There's also going to be a permanent aggregate output floor, which at consolidated level, which instead of relying on internal as it were, internal standards that are being set by the banks themselves. There's going to be a standardized approach, at least at consolidated level. The good news is reduced risk weights for low-risk residential loans, harmonized definitions of reporting on ESG risks, and indeed there's going to be some very detailed disclosures required by banks in terms of ESG risks going forward. But interestingly, no move in terms of a prudential regime for banks in terms of the whole sustainability agenda. Only a couple of weeks ago, the EBA issued again another warning saying that they did not believe that a prudential regime with respect to sustainability, particularly with respect to environmental risks, was necessarily mature enough. They drew the conclusion that environmental risks don't necessarily translate into financial risks, and they urged the Commission not to go any further without further in-depth assessments of the pros and cons of this particular move. And instead, the EBA has proposed perhaps some tinkering or some targeted more disclosures in relation to environmental infrastructure risks of a longer term that could be subject to a prudential regime as a standalone ruling. So clearly, we're not likely to have by 2025 a prudential regime for sustainability unless there are any changes of view from the Commission or indeed from the European Parliament, who are pushing for a more stringent regime. There's going to be, for the first time perhaps ever, harmonized fit and proper rules for key function holders, something that didn't exist in previous iterations of the Capital Requirements Directive. And all of this, of course, still needs to be discussed, reviewed. There's good progress being made. There seems to be a very good level of harmony between all of the MEPs, regardless of their political affiliation, in terms of the way forward. The SME support factor is still in there. So is a certain aspect of the green support factor, but quite visibly we are looking at some pretty hefty capital charges, particularly in relation to credit risk and counterparty risk going forward. The other big issue on the agenda is the sustainability risk disclosure regime. Now, the important more recent issues surrounding this is the Commission's attempts to include or classify nuclear and gas energy in the sustainability taxonomy regime, which is still being opposed, particularly the gas side of things, by a number of member states. We're not quite there yet, but at least we, in the light of the geopolitical crisis we're going through, which has put massive pressure on the import structures and profiles of our current suppliers of gas, clearly this is being brought into the entire discussion as we move forward. Clearly, gas and nuclear energy will ultimately be considered in some way as a transitional taxonomy issue going forward. The other factors, of course, an announcement a day or two ago by the ECB that they will start no longer buying corporate bonds that do not apply the taxonomy framework. They will do this on an incremental basis, but it's already a sign of where central banks will be going in the future. Obviously, the two important standalone flagship pieces of legislation, the Sustainability Finance Disclosure Regime, which requires banks, AIFMs, UCITS managers to provide standardized disclosures on how ESG, particularly the E environment factors, are integrated both at entity and product level. So they will have to report on how sustainability risks of their own investments in the economic activities are managed, number one, and how they potentially impact both the environment and people. And this for companies, banks, they will have to publicly start reporting the percentage of the current revenues coming from activities aligned with taxonomy. That's under the Corporate Sustainability Reporting Directive. The percentage of the future revenues, capital revenues coming from these activities which are aligned with taxonomy. So there will be a so-called green asset ratio. There will be taxonomy aligned activities vis-a-vis total activities to be measured, quantified and disclosed going forward. And there will be the famous key performance indicators in terms of fees and commissions, in terms of income versus non-taxonomy factors going forward. So a lot of important issues associated with these two important pieces of legislation. It also has to be said there are some delays, notably in relation to further clarifications that are required under the taxonomy regulation relating to articles 8 and 9. As you probably know, these have been highly controversial, where Article 9 deals with dark green funds, financial products which have a sustainable investment as its core objective. They will have to start providing from 2023 onwards taxonomy disclosures, contribute to environmental objectives to which the investments underlining the product contribute to, such as water usage, climate change, adaptation and mitigation, transition to the circular economy, pollution prevention and control, etc., etc. And importantly, a description under this sustainable financial disclosure regulation of how and to what extent the investments underlying the financial product are in economic activities that qualify as being environmentally sustainable. Now, in spite of the geopolitical crisis we're going through, there have been calls to perhaps allow a lengthier transition period. That doesn't seem to be the case, but certainly some clarifications are being brought, I think somewhat helpfully by the Commission and by the ACES in terms of Article 9 and Article 8, which deal with light green funds. So perhaps we can move to the next slide, please. Completing the Capital Markets Union. We are still struggling here in Europe compared to the US. We still have, if we listen to the ECB, the European Commission, ESMA, we still have a situation where banks provide the bulk of funding to the real economy in Europe, both at SME and household level, compared to the US, where 80% of the funding is provided by the capital markets. We're still a long way away from reaching that particular goal. So the CMU has been revised. We're now focusing more on promoting non-bank financing solutions. For instance, cultivating EU institutional investors and pension funds to think more in terms of investing in equity products. And indeed, there's even talk about providing some tax reductions or mitigating the tax effects that are normally associated with equity financing vis-a-vis debt financing to make it easier for companies and also SMEs to access the equity fund market, as it were. There is an area, of course, that still needs to be addressed, and these are the insolvency rules, which remain very fragmented, very disconnected across Europe. That will probably be a little bit more difficult. And a shift to perhaps encouraging more financing of high growth sectors via equity rather than debt. So further, I think, work on this going forward under the Czech Republic presidency. Promoting EU strategic autonomy. Now, we've heard a lot about strategic autonomy, not just in the financial services sector. Going back to the COVID crisis, we discovered in the heat of the COVID pandemic that Europe, the European Union, was highly reliant to 90% for its generic medicines on two major regions in Asia, which did, I think, raise some alarm bells. We've also heard similar concerns about telecoms. Now, the Commission is turning its attention to the financial sector. And in its January 2021 report on promoting strategic autonomy and resilience of the EU financial sector, particularly the banking sector, they spoke about reducing excessive reliance on non-financial services firms and banks, particularly in the EU, where EU-denominated contracts were cleared and settled by third-country CCPs. Funding in foreign currencies were largely handled by third-country banks. And the ECB, actually, as we speak, is finalising some detailed reviews on how non-EU banks could manage clients and their assets based on the EU, where they continually repeat that what is needed going forward is third-country banks and investment firms who have staff and capital that are located in one of the or multiple EU member states aiming to avoid empty shell type entities going forward. So that's a continuing issue as we go forward. Clearly, this is having some resonance also in the area of encouraging more local financing of banks rather than intra-bank financing going forward. And it's also having some obviously important, significant implications in terms of how third-country bank branches will be handled going forward as well. It's quite clear that, as the Commission has pointed out in its own document, Europe, the European Union, is probably the only major region in the world where foreign banks apparently can provide certain banking services remotely without having the presence, physical presence of either a subsidiary or a bank branch. And clearly this is going to be strengthened and clarified under the Capital Requirements Directive version 6. We have some revisions, important revisions coming in.
Sorry to interrupt you, David.
Yes.
We have quite a few questions from the audience. So can I just get you to wrap up and we get on to the questions?
Sure, by all means, by all means. So let me just wrap up maybe on some of the critical issues that have been contentious, but notably this issue of delegation rules, clarifying the delegation and outsourcing rules. You may recall that since Brexit, ESMA and a number of mainland European states have been calling for stricter rules, either a total ban on the delegation of critical services such as risk and portfolio management, legal services, certain marketing services, but also legal services that are conducted in third countries. The good news is under the revised MiFID regime, the Commission has proposed and looks as if it's going to seek approval on maintaining and sustaining the delegation model as it's applied to AIFM and UCITS managers going forward. So that's the good news. There was a fear that this might be banned, but it will come with some very strict pre-notification rules, which means that all third country banks and insurers, but mostly banks and investment firms, will have to submit their plans for continuing to delegate critical activities back to third countries, whether it be Boston, New York, Tokyo, Beijing, or elsewhere. But clearly we're moving in the right direction towards more disclosure by third country entities if they wish to continue to use the delegation model. We're also moving towards replacing the double cap volume for dark pools by a standard 7%. We're also abolishing open access rules, allowing buyers and sellers of derivatives listed on exchanges across the EU to choose where they wish to actually clear these contracts. Next slide, please. It would be amiss of me not to talk on the next slide here about Brexit. Where are we going on this? Well, it's slow. It's very slow progress. What we have is derivatives clearing exemptions continuing for UK-based CCPs into mid-2025. That's the good news. But we have no access clarity or relief or equivalency arrangements for share trading obligations and for derivatives obligations going forward. Indeed, we don't seem to have any progress on the EU equivalency regime going forward. And quite clearly, this is going to have to be addressed before mid-2025. However, there's not all bad news. Clearly, there are alternative existing models for access by third country investment firms and banks to the 27 EU member states. We've mentioned one already, the setting up a branch, but also dual hatting, where you get seconded staff for a specific period of time who are authorized AIFM UCITS managers who can be attached to that company, UCITS management company in Estonia, Germany, or elsewhere, or from a third country. So that still exists. Exploiting divergent national access rules through the national private placement schemes. Well, we all know there are divergences here. Some countries are more relaxed about a national localized equivalency agreement. Guernsey is a good example. They've been using this national private placement scheme for selected markets for many, many years, and it seems to be working. And it has to be said, the MiFID access rules still allow a third country to service wholesale business to eligible counterparties and elected professional clients in any of the 27 EU member states on the back of national private placement schemes. So that still exists. Next slide, and then I think we can maybe we can just touch on the last point, which is kind of important. This cuts across all financial service activities. We are heading for the creation of a standalone autonomous EU anti-money laundering agency in place by potentially as early as 2024. This will have huge powers of supervision, of investigation, of sanctioning over the top 37 systemically important financial institutions crossing banks, investment firms, insurers, both indigenous and third country. And it will replace and it will certainly dilute the national competent authorities' role that it currently has in terms of supervising large systemic financial firms in terms of their compliance with anti-money laundering rules as set down by the EU, which they have struggled to deal with because of the cross-border nature of many of these financial institutions. Also inherent in this package is some rules concerning beneficial ownership requirements, which are going to be further clarified, and measures to combat the misuse of bearer instruments. Added to this, we have some new rules concerning the misuse of shell entities. This is not just about third countries anymore, which are used for tax purposes. There will be some imposed mandatory indicators of minimum substance, such as owning a premises, having at least one own or active bank account in the EU, having one or more directors, having a residency in one of the EU member states. So quite visibly, it's a very game-changing and very innovative system going forward, which will affect not just third country financial institutions, but all systemically, at least initially, all systemically important financial institutions that operate anywhere in the 27 EU member states. So there will be a separate chapter, by the way, for third country institutions with additional due diligence measures foreseen. On that note, let me pause there, Charlotte, and thank you.
Thank you very much. So Bob McDowell's asking, do you see more tensions between national central banks and the ECB in terms of managing inflation, the deteriorating economic outlook and prospects of Eurozone countries?
Well, no. I mean, the ECB, as far as the Eurozone countries, the policy in relation to inflation, interest rates, is very much in the court of the ECB. In fact, one of their key mandates, the ECB, that is to manage sustainable levels of inflation, as well as overseeing, at least for the Eurozone countries, the interest rates. And as I said earlier, we are poised soon to have a an increase in interest rates, perhaps predictably not as assertive as the US, but we're heading broadly in that direction. For the non-Euro zone states, clearly they will be doing their best to control, combat runaway inflation. It's not good for imports of gas, of oil, which is highly, first of all, is practically all denominated in dollars, but also more importantly is an inflation booster in its own right. So I think there's a general level of, if you like, alignment across the 27 new member states that, combat inflation must be a priority over the next, 6 to 18 months.
Okay. Rick asks, what are the latest developments in data sovereignty regulation for European banks that use foreign, i.e. American, cloud providers?
Yes, we have some cloud legislation at the moment in place, which is was largely drafted with the view to regulating cloud providers in Europe. There's a separate regulatory regime on its way for third country iCloud data providers, which obviously are more stringent. What I suspect we're moving towards is something like we have for the crypto asset issuers providers who are based in third countries. They will have to follow the entire regulatory regime. They will have to be based in the EU. They will have to have at least, if not, at least 2 directors who are resident in the EU. They will have to be subject to data infrastructure, data anti-data tampering rules. All of this will be part of this new regime, and to try and bring the two as closely together as possible. It's a complex area. And clearly, the third country iCloud providers are minded now, in anticipation of all this, to ensure that they have a residency in one of the EU member states, which offers them a passporting possibility throughout the rest of the EU.
And on that note, Dan asks, has there been any progress on taxation harmonisation for global corporates?
If we're referring to the global tax deal issued by the OECD and adopted by the OECD members, which is now currently being negotiated at Council and the European Parliament level, the answer is no. Bulgaria is holding out for a number of concessions, and until there is a fully fledged endorsement approval of this standard 15% corporate rate that's been proposed, the legislation or the act cannot be enforced. There needs to be unanimity by the 27 new member states, which has led to certain, by the way, questions about whether tax policy should not be brought within the remit of the EU treaty to ensure that there is a different approach to approving important pieces of legislation, such as corporate tax, the one we've just spoken about. But for the moment, we are still waiting. I think it's Bulgaria that's holding out. I don't think it's going to last for long, but in the next 6 weeks, I think we will have a fully fledged agreement. We still have a couple of regulatory technical standards that need to be established before this becomes fully applicable across the 27 EU member states.
Okay. Bob McDowell also asks, inevitably in the fast-moving geopolitical environment, regulators play catch-up. Is the Commission sensitive to this lag in its regulatory regime to the extent that their measures may be redundant by the time they are enacted?
Yeah, it's